Hello, guys and girls too. Hope everybody is well today. In this topic that I want to review, I decided to take a look at calculating value at risk. It's abbreviated VAR. We're going to use Python, of course. And this is going to be highly financial focused. One thing that I'm going to try to do with my channel is take it in a little bit more of a financial direction. I did a whole bunch of data science videos all through last summer, last fall, and last winter in 2024. And we discussed all kinds of topics, covering pretty much all the major topics in data science. So I think it's pretty comprehensive that my channel is at this point, and I'd like to continue to do a few things like that, but I'd like to start to focus a little bit more on financial topics. I think it's very interesting, very relevant, very important for so many different reasons, right? If you understand your finances, you will have a pretty decent life, right? You're going to have a pretty cush, comfy life. If you don't understand finance and if you can't manage your finances very well, you're going to have a very difficult life, okay? Um, that's not negotiable. That's a fact. Okay. So I think in an effort to try to help people a little bit more, I'm going to focus more and more on financial topics to help people understand this. It's fairly complex. It can be somewhat simple and straightforward, but most financial scenarios are quite complex, right? So I'm going to take some time in early 2025 to try to break it down and help everybody understand the nuances of finance and the topics of financial services. Okay, so what's value at risk? Basically, it's a key metric to understand risk management, and this can help an organization quantify the potential loss of their portfolio of investments, right, based on a specific time horizon and a certain level of confidence. We're going to use 95%. You can use different levels of confidence, 90%, 95, 99%. The higher the level of confidence, the more precise your calculations. Okay, but there's going to be exceptions to that too. You can have what's called a fat tail. A fat tail is when an event occurs. It's a highly unusual event, almost um, imperceptible or incalculable event, but it can actually destroy your business. There is a company, an investment company called Long-Term Capital. I think they're around for about 3 years, and then they had to liquidate all their assets. Well, whatever was left of their assets, because they had some errors in the Russian ruble market. They invested heavily in Russian rubles and a whole bunch of other things. But the tail was pretty fat. They didn't understand the risk, or maybe they didn't expect the risk. Let me rephrase that. I think people at work, they were highly intelligent. I think they didn't expect the risk, but when the Russian ruble devalued, it cascaded into a bunch of other problems. And long-term capital management, I think, was out of business in about 3 years. And when I looked at the name, it's called long-term capital management. You'd think, okay, they're going to be around for the long term, but they were not, because they underestimated the the risk, the tail risk, which can be very fat sometimes. So let's try to take a look at that. Okay. So why do we calculate VaR? Again, to quantify potential losses, understand risk, capital allocation, risk comparisons, stress testing, scenario analysis, simulation analysis, and there could be heavy regulatory compliance requirements as well. Okay, so in the financial services area, there's a lot of compliance. Certain industries have more compliance, certain industries have less, and finance is highly compliant, right? So there's a bunch of governing entities that oversee everything in the capital markets: FINRA, SEC, Federal Reserve. Okay, so there's a bunch of big brothers watching over you. Okay, so there's three different types of three different types of VaR that we will look at today. Parametric approach. This assumes normal distributions. It's best for straightforward linear types of investments, stocks, bonds, something like this. Suitable for large portfolios with diversified assets. By its nature, if your portfolio is diversified, you shouldn't have to worry too much about risk. If you're concentrated in one or two areas, then risk is going to be much more of a concern for you, okay? So historical simulation is the second type of VaR methodology that we will look at today. This uses actual past data, okay? So it doesn't assume normal distribution like the parametric approach. Historical looks at actual past data. We'll see an example of that. And this reflects real world shocks to the system, Update my notes here. And it's best for portfolios with non-normal returns. Okay, so a normal distribution bell-shaped curve, if your data is like that, you use a parametric approach. This would be highly diversified portfolio of assets and I'm sorry, of stocks and bonds. If you had a non-normalized or not bell-shaped curve sort of distribution of the riskiness of your portfolios, including options and derivatives, which are pretty complex financial instruments, you would look at a historical simulation. And in fact, if your portfolio was even more complicated than including options and derivatives, and you had all kinds of nonlinear relationships between your investment assets, this can create a very highly uncertain type of scenario, which is very hard to model and hard to predict. But Monte Carlo simulation can help us in this type of event because it looks at a whole bunch of different scenarios, right? Where we're looking at almost any possible scenario that you can imagine, tens of thousands, hundreds of thousands, maybe millions of different scenario events can be generated and interpreted by a Monte Carlo simulation. Okay, so let's jump into it. I am going to pull in Apple data for the past 5 years. I think 5 years of history is good. In some cases, you wouldn't need this deep of a history of data, but when you're looking at VaR types of calculations, you can't just go back 6 months or 12 months or even a couple of years. At least 3 years, 5 years would be preferable, and even more would be better. So in this case, we are going to look at 5 years of returns. Excuse me for a second. Okay, 5 years of returns. Sorry about that. The recruiters call me all day, every day. I get about 100 calls a day here. So, okay, so we're pulling in historical data, right? And I'm going to go ahead and run this cell. And we can see here's the history right here. We have 1,258 rows in a normal trading year. You have about 200 and I think it's 252 trading days in 1 year, minus the weekends, minus holidays, Christmas, New Year's, Thanksgiving, days when the market is closed, 4th of July. Okay, so let's look at the first example here. This is a parametric VaR calculation. We are going to look at $100,000 of investment. Actually, let me blow that up a little bit. Let me make that 1 million and then 10 million. Okay, 0, 0, 0, 0, 0, 0. So the portfolio value will be 10 million. We're looking at the mean return, which we just pulled in from our historical data right here. So our data.daily returns, that's over here, okay? And I created a feature from the existing feature. So we have adjusted close, closing price, high, low, open price, and then the volume of stocks traded that day, okay? And the daily return is going to be basically creating a new feature here, data daily returns, and that is a consequences of adjusted close, percentage change, and we're dropping any NA. So the percent change between the daily close or adjusted close rate, percentage change between that and that. So if you look closely, the first row we have an and because there was no change from the first, but between the first and second, it looked like it went up 1.6%. Okay, so that's how we're getting that value right there. So we have the mean returns. That is what we just looked at, daily returns. And we're taking the mean of that. We're taking the standard deviation of that same feature right there, and we're getting a confidence interval of 0.95. So like I said a few minutes ago, we are going to be 95% confident that whatever scenario that we see when we run this parametric VaR model is going to be within the range of what we expect. Now, there's a 5% chance that the loss can exceed this prediction that we're going to make in just a second, but that's pretty rare, right? 95% of the time, we're going to be within the range that we expect. The extra 5% is going to be highly unusual, but again, it could happen. That's what happened to long-term capital management, and it could happen to us if we are not careful, right? So we have to keep our wits about us and try to be careful here. So we're taking the AZ score, 1 minus the confidence level. That's what we just set right here. And we're going to look at the parametric VaR daily. This is the z-score, which we just calculated here, times the standard deviation, which comes from here, times the portfolio value, which comes from here. Okay, I think we're in good shape. And then we're taking the square root 252 trading days in a year. And basically, we want to annualize this. Okay, so we have the daily VaR here. We want the annualized VaR. So in a lot of cases in the financial realm, you try to annualize everything. Okay, so portfolio management is one classic example. You want to annualize your returns. If you say to your stakeholder or to your client or whatever, okay, I got 10% return. What does that mean? 10% return in one day? That's a good return in one day. Is that 1 week, 1 month, or 1 year? Well, you should annualize it, right? So everybody is comparing apples to apples. If you get 10% return, if somebody doesn't specify, I would assume that's 1 year because it should be annualized. If it's not 1 year, then you have to notify the person of that because they're assuming it's going to be 1 year. So we're going to annualize this, hit Control Enter, run the cell, and we have a daily. Oops, I think I hit the wrong thing. I hit my picture or something. Take a picture of the screen. Okay, Control Shift Enter, Control Shift to run it, Control Enter to run it. Sorry. Okay, Control Enter to run the cell. Okay, so we got it. We have our parametric value right here. So 328,000 is the daily value at risk, and annualized value at risk is 5.213. Okay, 5.2 million annual, 328,000 daily. So on a $10 million portfolio, here's our investment. In any one day, we could lose $328,000 or less, or make money, but we're probably not going to lose more than that. There's only 5% chance we'll lose more than that. In 1 year, there's only 5% chance we'll lose more than that, right? 95% of the time, we'll lose less than 5.2 million, and that's the worst case scenario, hypothetically, right? Like we'll probably make money if we have good asset managers, professional money managers handling this portfolio. Again, this is the worst case scenario that we can conceive of, so it's probably not going to happen. But the VaR calculation is helping us understand what is the value at risk here. Okay, this is our profit. This is the opposite. This is losses. But again, this is the worst case scenario. Probably this portfolio, if the managers have any clue what's going on, they will probably make at least 10, 15%. So 10% on 10 million is 1 million. You'll probably have a 1 million gain, maybe 1.5 million. That would be 15%, maybe even 2 million gain. That would be up 20%. That's a little bit on the upper end of investment returns for 1 year. 20% return is fantastic. Again, this is the worst case scenario. So 320,000 in a day, 5.2 million in 1 year. Let's look at a different type of methodology here for calculating VaR. I have to go ahead and take this data frame and normalize it. It comes in by default. If you look at this, this is called a multi-index data frame. So you have indexes over here. These are the headers. Then you have the ticker and you have the symbol repeating itself. Totally normal. Okay, that's totally fine. It's just the way that the data comes in. I think Yahoo changed this a couple of months ago because I recall it used to come in pretty normalized, but about 2 months ago, something changed. I had to go back and refactor a couple of my models because of this change on Yahoo's end. I don't know what drove that, but that's fine. We can accommodate it here. So we have a multi-index data frame. We have to take that and normalize it. That's what this code is for. Then we can proceed on to our historical simulation VaR. Okay, so we saw the parametric. This is the historical simulation, 301,244. So a little bit lower in this case. It's a more sophisticated type of analysis. This is 320,000 in a day, 5.2 million in a year. This is 301 in a day, 4.7 million in a year. Okay, and again, that's the worst case scenario. Probably won't happen, but we have to be aware of this, right? Because it is a potential threat, potential risk. So how do we get this? Again, confidence level 95, historical VaR. We're taking the percentage of the daily returns. Remember, we calculated that from the initial feature of adjusted returns. We have the historical VaR times the portfolio value, and then we're just printing out the results. So it's a pretty simple calculation here. It's only a couple of lines of code, right? So a couple of lines of code, and that's what makes Python very user-friendly, very scalable, up and out. And I think this is actually the most popular programming language in the world right now. Let me Google this. I bet it's definitely up there. Most popular programming. Yeah, okay. Let's go back. Oh, TIOB index. I have no idea what that is, but it's the first thing that came up. Let's take a look. Python right there. Okay, so 28%, and it went up 9%. Whoops, sorry. Skipping around now. So 23%, almost one quarter of the people in the programming community use this, and it went up 9.3% last year. So pretty big jump. So that's number one. And this is why, right? Because it's pretty simple and straightforward. You have to understand the concept of what we're trying to do, historical VaR. But once you get that, it's only a few lines of code, right? Like 1, 2, 3, 4 with some comments. So pretty nice, right? Gotta love it. I gotta love this stuff. So the more observant people here will see that the VaR is actually not much larger. It's actually, I made a mistake because initially my portfolio had 100,000, then I put up to 10 million, is slightly lower. That was my mistake. Initially I had, for the parametric VaR, I had it set for 100,000, then I reset it to 10 million. That's why. So now we're comparing apples to apples. Sorry, I did this late last night. I was kind of tired. So the historical VaR looks at historical actual prices in the market. That's why we pulled this data in from Yahoo Finance for Apple, right? We want to see historically what was the actual real data, the real market close price for each day, okay? And I don't think Apple cares about this per se, but again, it's more like asset managers, investment managers, hedge fund managers. If you're investing in Apple, you want to know what the VaR is for Apple, right? So that's why we're doing this. And what else? We're calculating the VaR based on historical returns. I just said that. Historical simulation is based on actual historical returns. Okay, it's getting a little redundant. And now comparing to the parametric VaR, that was the first example, right? It's more of a normal distribution. We can understand and estimate the risks more accurately and more, I guess, more coherently. Historical VaR is a little bit more kind of Wild West, a little bit more black box. But again, like this historical VaR is designed for these actual historical stock price changes over time. Okay, the parametric method uses z-score, so pretty standard statistical analysis, and assumes normal distribution. Okay, I think we touched on that. And it's based on assumption of normality, right? Where the historic VaR can be normal, it can possibly be abnormal, but the parametric VaR will almost certainly be a normal distribution, right? Okay, so in the next example, we're actually going to generate random paths using a Monte Carlo simulator. This calculates portfolio changes from simulated price paths, right? So in the first case, we're looking at very simple, straightforward bell-shaped normal distribution curves. In the second place, we're looking at actual price changes over time. Now let's assume that we have highly risky assets in our portfolio that have nonlinear relationships. So we need a tool that can help us generate thousands of different price paths and potential price changes over time, and then analyze those. Okay, so this is almost like it's called stochastic or random walk. It's called a random walk too, because you don't know what the outcome is going to be, right? But we're going to take a look and try to dissect it and figure that out. So we have our confidence level, mean return, standard deviation, just like before. Number of simulations. We'll put this up to 100,000. I just ran it. It goes pretty fast, honestly. Like you can set this to millions, and it should run pretty fast. So the portfolio value again is 10 million. We want to compare apples to apples, like we did in the prior two examples. So we have the portfolio value plus 1 times simulated returns. So these are random samples, okay, of the mean return. Okay, so we have the mean return here just as a starting point, but we're not just looking at these historicals. These are historical actual returns. We're taking random samples based on those mean returns. Okay, so we get simulated portfolio values, and then the daily VaR. Okay, and then down here we are getting the annual VaR. Again, annualizing this like you would do in any type of financial setting, I guess, in the financial domain, you try to annualize things. You should be annualizing things, right? So if you say it's 10% return or 15%, I know that's 1 year, not 1 month, not 1 week, not 1 day. So now the amount of risk is 315 and 5.015. Well, over here we had 301, so the historical is slightly lower because this portfolio is pretty standardized, pretty normal. This shows a higher VaR down here, so more value at risk 315,000. With 95% confidence, we're not going to lose more than that. We could, right? There's a 5% chance that we could, but it's highly unlikely. So Monte Carlo simulations provide more flexibility in a way that we can't necessarily anticipate what's going to happen, or we're trying to anticipate what's going to happen. But based on historical returns, we know actually what happened. But going into the future, we don't know if that's going to continue, right? What happened in the past is no guarantee of what's going to happen into the future. So let's take all of our accumulated knowledge here and create a chart. So Control Enter to run the cell. And let's see what we come up with. This is a Plotly chart. I like Plotly a lot because it creates visuals that are interactive and dynamic. You can mouse over this. Okay, you can even zoom in and zoom out. If I want to zoom in here, I can see historical simulation VaR is orange, parametric is blue, and Monte Carlo is green. Okay, so that shows us a nice distribution of the returns. Again, we're looking at the worst case scenario. This is okay, 300,000. So this is actually daily. This is daily, remember? So if I put the mouse over these things over here, 350K for the, let me zoom in here. Hang on. Oh, I see parametric VaR 328K. Okay, so now I see it. And if you go back up here, you should see exactly the same thing. Parametric VaR 320. Okay, so exactly right. So we're good there. Now let's say this is a nice way to consolidate all charts into one. If you want to save space on your screen or share this with your stakeholders and everything is aligned in just one spot, and looks pretty neat and low, very orderly. But things get a little bit jammed up over here. If you look at the top, it's a little bit hard to make these out. I see 301. That I believe is the historical simulated VaR, and then these two kind of blend together. So you can jiggle around with the chart a little bit and try to get that in better shape. But maybe a better way would be just to create 3 separate charts. Okay, it takes a little more space on the screen, and you'd have to print out probably 3 different pieces of paper if you're putting this into hard copies. So again, the parametric VaR 328, this is all by itself. The chance of losing anything to the left of this line is only 5%, highly unlikely, but again, it could happen. The historical VaR is 301,000. Okay, and you can see how it's not quite bell-shaped curve, but somewhat normal-shaped, right? The parametric VaR is very bell-shaped curve, and the Monte Carlo simulation tends to be somewhat bell-shaped because you're running 10,000 scenarios. So over time and over so many scenarios, things are basically going to distribute in a pretty normal fashion, and that's exactly what we see here. And the VaR is 315 with 95% confidence interval, right? So just to summarize things, practical use cases is for a portfolio of stocks. Parametric VaR is for simplicity, assuming normal returns. If you have options or derivatives in your portfolio, you would not use this. You would use historical or Monte Carlo VaR to capture the nuances of these investment vehicles, which are highly volatile and highly complex too. Maybe I should do a video on that sometime soon to explain how these work. That could be something worth considering. I'll have to put that in my back burner there. So high market volatility, you'd probably use historical simulation. It's going to perform better and more accurate than a parametric VaR. And hedge funds with complex assets, again, you want to consider the Monte Carlo VaR over the other two. So I think we beat that horse to death. And just to summarize again, this is a very simple, straightforward example. You can have lots of data feeds into your VaR calculation. This is just market prices, just for Apple. Realistically, you're probably going to have not just Apple, unless you're a huge fan of Apple, you'll probably have dozens of different assets in your portfolio, maybe several dozen, maybe hundreds, right? So you'd have to calculate the VaR of all of these and then aggregate that into portfolio and then calculate the VaR on that portfolio. So I think that's beyond the scope of this discussion here. That gets kind of complicated. If there's interest in that, you can put that in the comment section, guys. If you really want to see that, I can put that together. I think that that is the exception, not the rule. I don't think most people are into that unless you work for uh, some type of sophisticated hedge fund or asset manager that really has a need for that kind of thing. I think that goes above and beyond what needs to be discussed just for the basics of VaR. But again, a couple more things in the notes here: liquidity risk, understand tail risk. Okay, beyond VaR, that's everything to the left of this vertical dotted line here, and this is done for stress testing, scenario analysis, simulation analysis, and this could be a requirement for the regulators, right? Finance is a highly regulated type of industry or sector or whatever you want to call it, and this could be absolute mandatory requirements to meet your compliance needs for your bank or your investment institution. Okay, so that's pretty much it. I'm wrapping up here. Thanks for your time, everybody. Goodbye.